You think you understand candlesticks? But you're using them the wrong way. Let me show you the simple way to read them. Fire.
A candlestick is a visual representation of price movement on a chart. The red and green shapes you see are called candles. Each candle represents a specific period of time depending on the chart time frame. For example, on a 30-minute chart, one candle represents 30 minutes of price action. Now let's understand the four main components of a candlestick. First, the high price. This is the highest level the price reached during the time period. Second, the open price. This is the price where the market started at the beginning of the candle. Third, the close price. This is the price where the market ended at the close of the candle. Finally, the low price. This is the lowest level the price reached during that time period. These four elements together give us a complete overview of each candlestick and help us understand how price is moving in the market. Let's talk about the candle. Every candle behave a two main structure. First, the body. Second, the wick. Now, let's talk about how to identify a strong candle body versus a weak or small body. A strong candle body means there is a big distance between the open and the close. This shows strong momentum in the market, where buyers or sellers are clearly in control. On the other hand, a small candle body means the open and close prices are very close to each other. This indicates weakness, indecision, or a lack of momentum in the market. In simple terms, a large body reflects strength and direction, while a small body reflects hesitation and uncertainty.
Now let's talk about the wick. The wick is the thin line above and below the candle body. It shows how far price moved during the time period beyond the open and close. A long wick indicates that price tried to move in one direction but was rejected. For example, a long upper wick means buyers pushed the price up, but sellers came in and forced it back down. A long lower wick means sellers pushed the price down, but buyers stepped in and pushed it back up. In simple terms, long wicks show rejection and potential reversal, while short wicks show stability and strong direction. Now let's understand the difference between a bullish candle and a bearish candle. A bullish candle forms when the closing price is higher than the opening price. This shows that buyers are in control, pushing the price upward. It is usually represented in green. A bearish candle forms when the closing price is lower than the opening price. This shows that sellers are in control, pushing the price downward. It is usually represented in red. In simple terms, bullish candles indicate upward momentum, while bearish candles indicate downward momentum. In an uptrend, the market is moving higher, so we look for buying opportunities. If a bearish candle breaks below the trend line but forms a long lower wick, this means the breakout was rejected and buyers stepped back in. This can be In conclusion, candlesticks give us a complete picture of price movement in the market. By understanding the open, close, high, and low, we can read each candle clearly. The size of the body shows strength or weakness, while the wicks reveal rejection and market behavior. Bullish and bearish candles help us identify who is in control, buyers or sellers. When we combine all of this with the trend, candlesticks become a powerful tool to spot momentum, rejection, and potential trading opportunities. Mastering candlesticks is one of the first and most important steps to understanding how the market really moves.